Candidly, I'm confused when I go to some ice cream shops. They'll advertise 30 flavors of ice cream, and yet when I look around, some of those are gelato. Now, I realize some people would call that ice cream. I'm just not sure I would. Borrowers can feel the same way when it comes to companies who advertise hundreds of loan programs. Some of those loan programs won't be right for you, and some programs which I see advertised aren't really even loan programs at all. So let me give you the scoop in this edition of Mortgage Real Talk. Hello, I'm David from the Cramm Group here at Home Mortgage Alliance. You may have heard terms like FHA, VA, USDA, conventional down payment assistance, 30 or 15 year. You get the idea. Let's break down the common types of loans, the features of each, so you can be more informed when you're speaking with a lender. We'll start with the all-star of ice creams, the red, white, and blue. As a salute to our veterans, there's the VA loan. The VA loan requires no money down and has the added benefit of no monthly mortgage insurance. For some veterans, the VA does charge what's called a VA funding fee. Commonly, that's built into the financed amount of the loan. The program is available to current veterans, honorably discharged veterans, and spouses of deceased veterans. The chocolate ice cream of loans is at times more complex than vanilla. It's from the Federal Housing Administration, or FHA loan. This requires 3.5% down and has both upfront mortgage insurance, which again is typically built into the financed amount of the loan, and a monthly mortgage insurance. The monthly mortgage insurance never goes away unless you're refinancing. This loan is typically for people who have a touch lower credit scores or a bit more debt as a percentage of their income. Now, the vanilla ice cream of loans, that's really got to be the conventional loan. These loans are underwritten to Fannie Mae or Freddie Mac guidelines. They require 3% down at a minimum, and they do require monthly mortgage insurance unless you put 20% down, in which case then you can avoid the mortgage insurance. By contrast to FHA, conventional loans don't charge upfront mortgage insurance. In addition, once you're at 78% loan to value and you've been in the home or had that loan at least 2 years, you can apply to your mortgage servicer to have that monthly mortgage insurance removed from your loan. These loans are typically for people who have higher credit scores, more money down, and lower debt as a percentage of their overall income. Now, like a flavor you'll only find in a few stores, a USDA loan is available on specific properties designated as such by the U.S. Department of Agriculture. The loan requires no money down, but properties can be hard to find in some areas because they tend to be fairly rural and they have to be designated as such. Now, if you were thinking of a quadruple scoop cone, that would have to be a jumbo loan. As the name would imply, those are larger loan amounts for people falling above the high balance conforming loan limits. They typically require no mortgage insurance, but they do have higher credit standards, lower debt to income ratios, and they require more in reserves. Now, if we start talking about gelato, that has to be the down payment assistance, where those really, in most cases, are not loan programs. What they are is it's an assistance provided by the government or a government-related organization in most cases, and they're on top of FHA or conventional loans. We have a whole series on down payment assistance. I would encourage you to check that out. There are also a few loan programs. I've tried to cover about 95% of them here. The other 5% are kind of bank specific or community specific. We obviously won't go into those. I hope you found this video informative and helpful. If you have, please like it on social media and follow us there for more information. Thank you very much.